Beirut, October 2019. A woman named Rima walks into her branch of Blanc Bank on a Tuesday morning to withdraw $10,000. She has $200,000 in that account. She has been depositing into it for 20 years. The teller looks at his screen, then back at her, and tells her she cannot have it. Not today. Not tomorrow. The bank is not technically closed. The doors are open. The ATMs are lit up. But her money, all $200,000 of it, is, for every practical purpose, gone. She is not a victim of fraud. She is not being investigated. No law has been broken. The mechanism that locked her out of her own savings is something far more structural than a crime. And that mechanism is not unique to Lebanon. What happened to Rima and roughly 4 million other Lebanese depositors between 2019 and 2021 was not a developing world anomaly. It was the visible end state of a financial architecture that any government can build, and that several already have. The same conditions that made it possible are present in the U.S. financial system right now, not as speculation, as documented structural fact. This channel performs economic autopsies so you don't become the next case study. Subscribe if that's the kind of forensics you came for. By the end of this video, you'll understand the exact 3-part mechanism that turned Lebanon's banks into locked vaults overnight, and you'll be able to identify each of those 3 parts in the U.S. system right now. Let's start with what actually happened. Lebanon wasn't broke. That's the part nobody explains. For most of the 2000s and 2010s, Lebanon's banking sector looked like a success story. The banks were well capitalized on paper. The Lebanese pound had been pegged to the dollar since 1997 and held steady for over 2 decades. International depositors, Lebanese diaspora, Gulf investors, regional businesses poured money in. At its peak, Lebanon's banking sector held assets equivalent to more than 350% of the country's GDP. According to the World Bank, that ratio made it one of the most bank-heavy economies on the planet relative to its size. The banks weren't hiding losses. They were hiding a dependency. For the peg to hold, for every dollar deposited to remain worth exactly $1, the Banque du Liban, Lebanon's central bank, needed a continuous inflow of foreign currency. And the mechanism it used to attract that inflow was interest rates. Lebanese banks were offering deposit rates of 10%, 12%, sometimes 15% annually at a time when U.S. accounts were paying less than 1%. That differential was the engine. As long as money kept flowing in, the peg held, the banks looked healthy, and depositors slept fine. The economist Nassim Nicholas Taleb, who is Lebanese and wrote about this structure years before the collapse, called it a Ponzi scheme with a central bank at its center. New deposits were effectively funding the interest payments on old deposits. The mechanism didn't require fraud. It just required that the inflows never stop. They stopped in 2019. Regional instability, a slowdown in Gulf remittances, and a drop in diaspora confidence combined to slow the inflow just enough to expose the gap. And when the gap became visible, the withdrawal requests came faster than the system could absorb. That's when the banks did something that stunned depositors who had never been told it was legal. They stopped honoring withdrawals. Not through formal legislation, through what became known as informal capital controls, an arrangement between the banks and the central bank that had no legal basis, but was enforced anyway. Rima's $200,000 didn't vanish. It was still technically there, still accruing interest on paper. It simply could not be accessed. That distinction between money existing and money being available is the first part of the mechanism, and it should concern you, because it is not a Lebanese invention. That's layer 1. Here's where it gets structural. The 3 parts of the lock. What happened in Lebanon wasn't one event. It was 3 overlapping mechanisms activating in sequence. Understanding each one separately is the only way to see them when they appear elsewhere. The first is sovereign bank entanglement. Lebanese commercial banks held enormous quantities of Lebanese government bonds and central bank certificates, instruments called financial engineering products internally, which the Banque du Liban issued at yields that only made sense if you assumed the system would hold indefinitely. By 2019, the Institute of International Finance estimated that Lebanese banks had channeled roughly 50–70% of their assets directly into the central bank or the government. The banks were not lending to businesses or households in any meaningful proportion. They were, functionally, a pipeline for government financing. When the government's creditworthiness deteriorated, the bank's balance sheets deteriorated with it, because they were the same balance sheet. The second mechanism is the legal ambiguity of access. In most countries, deposit insurance and banking law create a specific legal framework around your ability to withdraw your own money. Lebanon's framework was thinner than depositors realized. The informal capital controls that emerged in late 2019, initially bank by bank, then coordinated, were never passed by Parliament, never signed into law. They were agreements between institutions. And because they were never formal law, they were also never formally subject to legal challenge in any efficient way. Thousands of depositors sued. A small number won token withdrawals. The mechanism remained intact because there was no clean legal lever to break it. The third mechanism is the haircut by inflation. For depositors who couldn't withdraw dollars, the banks eventually offered a workaround: withdraw in Lebanese pounds at the official rate. The problem was that the official rate bore no relationship to the market rate. By 2021, the black market exchange rate had the pound trading at roughly 15,000 to the dollar. The official bank rate was still near 1,500. A depositor who accepted the workaround received 10 cents on the dollar and was recorded as having been made whole. The mechanism produced a 90% loss that appeared nowhere in the formal accounting as a loss. Three mechanisms: sovereign entanglement, legal ambiguity of access, and structured haircut through currency. Each one individually is a warning sign. All three together are a trap. Now here's where it matters to you personally. The architecture is not unique to Lebanon. The U.S. is not Lebanon. That sentence is true and also carefully designed to stop the next sentence from landing. So let's be precise about what the comparison actually claims and what it doesn't. The claim is not that U.S. banks are insolvent. The claim is that two of the three mechanisms that made Lebanon's trap lethal are structurally present in the U.S. system today, and the third has a partial analog that most depositors have never been told about. Start with sovereign bank entanglement. In the years following the 2008 financial crisis and accelerating through the COVID-era stimulus period, U.S. commercial banks dramatically increased their holdings of U.S. Treasury bonds and government-backed mortgage securities. This was rational behavior. Yields were low, but the assets were considered risk-free. And regulatory frameworks under Basel III actively encouraged banks to hold sovereign debt as high-quality liquid assets. By the end of 2022, according to the FTIC's quarterly banking profile, unrealized losses on securities held by U.S. banks had reached $620 billion. Those losses existed because rates rose faster than the positions could be unwound. The securities hadn't defaulted. They had simply declined in market value, and the banks were sitting on the gap between what they paid and what the assets were now worth. You watched one version of this mechanism operate in real time in March 2023. Silicon Valley Bank held an unusually concentrated position in long-duration treasuries. When depositors requested withdrawals and SVB needed to sell those securities to fund them, The unrealized losses became realized losses. The bank failed in 48 hours. The FDIC stepped in. Depositors above the $250,000 insurance cap were, for a brief and terrifying window, in the same position as Rima in Beirut, until the Federal Reserve announced it would backstop all deposits, insured or not. That decision resolved the immediate crisis. It also confirmed something important. The formal legal protection for deposits above $250,000 is not a right. It is a discretionary policy choice made by a regulator under pressure. The FDIC's Deposit Insurance Fund, as of the most recent quarterly report, covers roughly 1.3% of the total insured deposits it guarantees. That is not a conspiracy. That is a published figure. The system functions because confidence in the backstop holds. Confidence held in March 2023. The mechanism that would make it not hold is the same one that operated in Lebanon, a loss of confidence faster than the backstop can respond. The legal ambiguity of access has a domestic parallel that received almost no coverage. During the 2023 banking stress, several regional banks quietly implemented withdrawal limits and extended processing times for large transfers, not through formal regulatory action, but through operational decisions made at the bank level. None of those decisions made headlines because the stress passed before they became the story. But the infrastructure for informal access restriction, the same informal structure that predated Lebanon's formal capital controls, exists and has been used within the last 3 years. The third mechanism, the structured haircut, has no current U.S. analog. That is the genuine difference. U.S. deposits are denominated in dollars that are not pegged to anything, which eliminates the specific currency conversion trap Lebanon used. But it also means that the haircut, if it comes, arrives through a different door, purchasing power rather than exchange rate. A dollar saved in 2020 lost roughly 20% of its real value by 2023 by the Federal Reserve's own CPI measures. That loss is diffuse, invisible, and recorded nowhere as a loss. The mechanism is different. The outcome, your savings buying less than you were told they would, is structurally similar. That is the historical record. Now here is what it means for how you think. What the informed observer does differently. This is not a video about moving your money to gold or buying farmland in Montana. The action layer here is cognitive, not transactional, because the most expensive mistake Lebanese depositors made wasn't a financial decision. It was an assumption. They assumed that the existence of their money in an account meant the money was accessible. Those are not the same thing. They are related conditions, both of which must be true simultaneously for your savings to function as savings. Lebanese depositors had the first condition and lost the second. The FDIC insurance structure, as currently designed, guarantees the first condition for balances under $250,000 and makes the second condition a discretionary policy choice for everyone. What the informed observer does is hold that distinction clearly. Not anxiously, clearly. You do not need to assume the system will fail. You need to stop assuming it cannot, because that assumption is what prevents you from ever noticing the warning signs. The warning signs in Lebanon were visible and documented years before 2019. The imp flagged the Ponzi-like structure of the Banque du Liban's financial engineering as early as 2016. The interest rates being offered were arithmetically impossible to sustain at stable currency, and any depositor who looked at the math could have seen it. Most didn't look. Not because they were unsophisticated, because looking felt unnecessary. The system had been stable for 20 years. Stability is not a guarantee. It is a track record, and track records end. The same forensic attention that would have served a Beirut depositor in 2016 is available to a U.S. depositor today. The FIC quarterly banking profile is public. The unrealized loss figures are in it. The coverage ratio of the deposit insurance fund is in it. None of that reading tells you the system will fail. It tells you the system has specific structural conditions, specific pressure points, and specific mechanisms that have operated before. In Lebanon, in Cyprus in 2012-2013, when a 47.5% haircut on deposits above $100,000 was implemented as a formal bail in Greece, when capital controls limited withdrawals to 60 per day for 3 weeks in 2015. The geography changes. The mechanism doesn't. Rima walked into her bank on a Tuesday morning with $200,000 in an account and 20 years of depositing behind her. She walked out with a withdrawal limit she had never been told existed. She is not a cautionary tale about Lebanon. She is a case study in what happens when the distinction between money existing and money being accessible collapses faster than anyone was prepared to recognize. History already taught you this. Nobody showed you the receipt. If this is the kind of forensic work that should be in your feed, subscribe, because we perform economic autopsies here so you don't become the next case.